computer power to do this. And who's going to make money out of this, right? Like besides for NVIDIA, right? Who's selling this, selling them the stuff. And NVIDIA is such an overowned stock. So anyways, the question is this like, is this just a scam? You know, is this like Sam Altman just scammed everybody? And like, and is this as well as much as it's the AI models, chat GPT models hallucinate, are investors hallucinating about the financial benefits of this? Obviously, I mean, somewhere down the line, you know, in some number of years, it will be, hopefully it will be refined and mean something. But anyways, read the Goldman. I'm not doing it justice. Goldman does a really good job of saying nobody, the benefit of this to the bottom line is very limited and for the foreseeable future. So basically, it's a lot of spending and no payback. That's their bottom line. Okay, Citi, next headline, Citi says it's time to book profits, high-flying AI equities. U.S. companies head into earnings season facing high expectations. I want to talk about that later. Okay, just keep going. Yeah, okay. Now is AI just another metaverse style flop? So here on this page, I write like 700 to 800 words. I never write anything until I've done all the analysis, you know, and then I sit and look at my notes and I write. So this is what I do. So you can read it in 2 minutes. You can, you know, I won't go into, you can read it. You can see what it says. So what kind of charged me into this was in the model forecast, I'm seeing, if you notice in this week's report, let's keep going down. Let's look at this chart page. The next page is chart pages. Okay, so just hang on there. So look at a lot of these FANG stocks have topped out or are in the process of topping out. To me, it looks like. So just look at the first one. NVIDIA, it's down about 5 or 6%. No big deal yet, but it's a couple of weeks past its top. That's on the top right, kind of a double top. Meta, look at these are absolute charts, not relative, by the way. So Meta basically is back where it was in March, and it's rolling over. So basically, it's kind of faked out. Didn't really. It kind of broke up to an insignificant new high, but didn't really follow through. Google did. That's the one next to that. Keeps going down. Scroll down, Mark, please. Amazon kind of went to a little bit new highs, but it's rolling over. Netflix rolling over. They report, you know, maybe they'll bounce on earnings. Who knows? Okay, then tech sector on the left. This is a ratio chart. You know, I look at a lot of what I do is look at ratios. You can see tech hasn't really had, it has this double top thing like NVIDIA. So there hasn't been, as much as there's been all this intense buying, I mean, I shake my head every morning. There's a huge buy program. Maybe it's the ETFs inflows or people from Korea or Japan or Taiwan. I don't know. Individual investors every single freaking morning. Buy, 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 buy. But look, the tech hasn't outperformed for a number of months now, basically back to May. So there hasn't been any alpha added by clinging to these tech stocks in the tech sector relative to the S&P. Now, the next one to the right of that, interesting, communication services. So, you know, S&P's kind of sliced and diced things differently, and they put Meta and Google, those are the two primary weights. They put it into this communication services sector, and it's interactive media is the industry group below that contains them. And look at that. This is a ratio chart. So it's basically been not going to new highs, and it just broke the 200-day average. And so those are my top two short ideas right now. Controversial, you know, Meta and Google, they're making a lot of money. You know, to stock analysts, they probably look great, earnings growth, except they're overvalued and everybody owns them. But basically, what is that saying? It's saying somebody's getting out. Like, it's not going down for no reason. This isn't not magic, hocus pocus. Beneath the surface, there's distribution going on. The people who made a lot of money in these stocks are bailing on them, and they're loading the pockets of whoever's buying them now, which is probably individual investors. And, you know, I wonder sometimes, are central banks, are they behind this? You know, because now they do a lot of stuff with their reserves. They buy equities, the Swiss National Bank. So I don't have any direct information on this, but I just wonder in the back of my mind, they're kind of novice investors. Haven't been doing this that long. But anyways, those two stocks, Meta and Google, rolling over, that sector rolling over. And then on the long side, bottom left chart, real estate. Nobody likes it. This is the worst performing sector year to date. Okay. XLRE is the ETF. And big reversal last week. Okay. So came off the lows. We're 1 week past the lows in real estate. And you can make probably this real estate stocks probably look terrible to stock analysts, they say credit, CMBS, credit, commercial real estate problems and people, retailers closing, blah, 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 blah. The fundamentals probably look terrible, but John Templeton, what do you say? The time to buy is at the point of maximum pessimism. The time to sell is at the point of maximum optimism. I think that's a great analogy. And I think so if you're looking for buy low ratio, something to rotate into in this change that we're going into in the market. Number one on my list in terms of sectors is real estate. And these are in the gutter. They went from the penthouse way back when to the outhouse. So they're in the outhouse. Nobody likes them. Good, perfect contrary indicator. So real estate, if you're looking for alpha, that's where to find it, I think. So if, in this rotation, so obviously we've hit this change, the Trump thing hit, and then Thursday, there was last week's, there was a big change in rotation in that intraday reversal where the CPI came out and they sold TMT stocks, Mag 7 stocks, and they rotated into all this other stuff. Okay, so I see a question about Russell 2000. I'm kind of agnostic on that at the moment. Yeah, it's working, but I think there are better things than just flat out, maybe on an index level that's working. But I'm looking beneath the surface, and I think there are better opportunities. So real estate would be number one. Now look at next to that GDX, right? So again, it's up huge today. It's up about almost 40% from I believe it was it was end of February, early March lows in the GDX gold stock ETF. Now that's number one on my list. We'll see in a second when we trade down, when we slide down. And again, gold stocks, I don't get a lot of positive, warm, fuzzy feedback about gold stocks. People don't really care about them too much. But if you're not getting it, I do also do this gold stock report where I cover all the investable, not moose pasture, real investable gold stocks with production and reserves. And so I screen across all of those, and they've just looked really good for a long time. So the model's been on the right. If there's one thing I got right this year, the model, it's gold. So that's been a huge outperformer. And it continues to be, again, today, it's breaking out. If you look, this is a relative chart. The absolute chart is breaking out today. Look at the chart of GDX or gold. And let's just talk about that for a second. So the model got that from the model, which doesn't know anything about this fundamental stuff. But in the big picture macro stuff, I've got to sell on the dollar. Okay, dollar down. And why would that? And a big buy on bonds. So my big macro themes are, for any of you macro traders out there, long treasury bonds, TLT. And I got a curve steepening. There was a question about that that was submitted earlier. So that's a couple weeks old. I have 30 to 5, but it's also 10 to 2. So basically, the short end, in other words, yields probably want to fall more than the long yields, which implies the Fed is going to cut rates, yes. And everybody goes, oh, we're going to buy stocks. We're going to buy stocks. The Fed's going to cut rates. Oh, God. Not necessarily. Maybe you get that knee-jerk reaction, which we're obviously getting at first. But the better play, if you are convinced, as I am, both on a fundamental view and on the model forecast, buy bonds. Like bonds are down. I mean, they're barely up on the year. They were down on the year. They've had this huge bear market for the last 3 years. So TLT, if you're really adventurous, there's an ETF called ZROZ. It's in the report. It's a 30-year strip, basically, 30-year zero coupon. So it's much more volatile. It's a couple times more volatile than TLT. But I like bonds, flat out long bonds, So why would bonds rally? The model likes them, but why? Because the economy is going down. It's going down the poop chute. Okay, so we saw those headlines in the press clips. My model forecast. So we're now how many months? 28 months since the Fed started raising interest rates. So March 2022, here we are in July 2024, 28 months, more than 2 years. That's slightly over the average time between a Fed rate hike cycle beginning to the economy goes into a recession. And we're seeing so the stock market is up, which is kind of disguising what's happening beneath the surface, where a lot of lower income consumers are getting squeezed by inflation. They can't afford to buy stuff, right? Their incomes are not up as much as the cost of as CPI and the stuff that all the insurance. I mean, you guys know this as well as I. Like if you look at your insurance bill lately, mine's like doubled or something. It's crazy. Health insurance, car insurance, home insurance, it's all gone through the roof. That's just one example. And it's not going down anytime soon. But anyways, so my overall view fundamentally is we're headed into an economic contraction. Interest rates fall and bonds rally in economic contraction and corporate earnings decline. My model's forecast for corporate earnings is down. So right now, depending on the source you use, LSEG, that's the London Stock Exchange, says earnings are expected to be up 10%. S&P 500, which Standard & Poor's, which I tend to use, it's more reliable. I've been using it for 35 years, ever since Bob Solomon, a real Solomon Brothers at Solomon Brothers, who was head of equity research, got me started on it. He said, just stick with the real numbers. So they have a forecast number there, a bottoms up number from analysts. It differs. So everybody's, FactSet's got one, LSEG's got one, Standard & Poor's. But they're all looking for a big second quarter earnings reporting season in advance. I think it's going to be a big disappointment. So usually what happens is the analysts, like they start cutting their forecasts a month or two before reporting season, and then they beat the forecast. Oh boy, they beat the forecast after they lower the forecast. It's such this game. I don't know why it goes on. Anyways, that it happens and you can't fight it. But this time they didn't do that. So they barely cut the forecast. And right as the economy is, heading into a brick wall, maybe not for NVIDIA, but for, a huge percentage, most of the percentage of the S&P 500 is not going to be having good earnings. They're probably going to be going down. By the way, reported earnings were down sequentially, annually, and from the top. Standard & Poor's, the real numbers, GAAP numbers, were down in Q1. The operating earnings were up a little bit, but they kept going down at the end of the quarter. I think something like that will happen this time. I think earnings are going to disappoint. So that's my scenario. I think as we head into earnings seasons, which is typically a time to ramp stocks, I think it's going to be a time when stocks sink. Okay, let's go down. Okay, so this page is MEGO, MEGO. My eyes glaze over. Let's not spend a lot of time on it, but if you want to know what Japanese industry groups, emerging markets, currencies, it's all in this table at the bottom. And a lot of time and effort goes into it. So if you want to know what the model says about a lot of obscure or, macro things, spreads, relative value trades, just to give you a capsule summary, stocks are supposed to outperform bonds. Hasn't happened yet, but it's supposed to start happening in the US and Europe. Dollar's supposed to go down. Tech and the communication services are supposed to underperform. Defensive sectors are supposed to outperform. Or what else? Dollar's supposed to go down. I already said that. Gold, right-hand side. Precious metals are supposed to go up. A lot of commodities are shorts, though. If you look in the bottom right, grains, the model's been on the right side of these. The grains have been falling out of bed. Has had that in there for a while. So that's another recessionary signal. So basically you can see base metals at the bottom, shorts, copper, nickel, aluminum working. They're going down. Then there for a few weeks or month. Grains going down. Only thing going up is precious metals. I have energy in as a long, not as super high confidence as metals, as precious metals. Okay, keep going down. Trade. All right, now here I imagine most people, most clients, this is what is the bread and butter of this report. Like, what do you buy and what do you sell? Okay, so just to give you, to remind you, if you don't already know, everything's ranked in here. So you'll see long ideas on the left, short ideas on the right. So, and what's the top on the left? Gold mining stocks. See those? BTG, that's B2 Gold. Gold, that's Barrick, Newmont. Usually those are the two largest cap stocks, gold stocks, Barrick and Newmont, that's ULD and NEM. Usually those are not leading, but they are in the model forecast right now, which suggests that institutional investors are going to be rotating, and they are rotating into these. And by the way, if you look at a chart of gold XAU long-term, last 5 years or so, maybe relative, gold is like breaking out to new highs, right? And the XAU and the GDX are still way below their peaks, back from a few years ago. So they've totally underperformed the gold stocks. I think there's a lot of catching up to do. And so I ran a press clip last week that gold price at a record means these gold stocks are going to be making boatloads of money. The product that they sell is, their revenues are going up, their profits are going up. It's not reflected in their share prices. So I think both from a fundamental stock analyst view and from a model forecast view and from a macro view, gold mining stocks make a lot of sense. They're working. They've come a lot, up, like I said, the GDX up almost 40% from its lows. But I think it's one of those things where you buy the dips. So I think they keep going up. I think we're in an environment where the dollar goes down, gold stocks go up. Look below that, REITs. These are the long ideas, REITs. I won't go into individual ticker names, but those are the tickers are the ones that are supposed to outperform the group. And they move around a little bit. There's a little bit of more volatility in the names than there is in the groups. The groups are more stable. So, and below that, it's defensive stuff. Utilities, tend to rally with bonds. They pulled back some. Pharmaceuticals. So the model likes healthcare. That's a pretty fresh signal, month or so. And biotech, which is odd, because I'm not, the model's not in favor of a lot of speculative stuff, but biotech's kind of in the gutter. So it's more like, it's more like the Amgens. If you look at that, it's the more of the real companies there, not the super speculative ones waiting for some FDA approval for something. It's more the major ones established, kind of like pharmaceutical type biotech. Energy stocks below that. By the way, energy MLPs are really interesting. If you haven't looked at them and you're looking for a defensive play in a recession, really high yielding. Some of these are 7-8% yielding, and they also have an upward model forecast, outperform. So you can both pick up some alpha and a huge dividend yield in the meantime. And really boring stocks. Look at this. So diversified telecom, Verizon, AT&T, tobacco stocks, water utilities, and below that, some consumer staple groups. The only tech group I have at the bottom is cybersecurity. Can you slide down a little bit, Mark? Okay, so cybersecurity, they're kind of in the gutter. So that's you might want to check that out if you're a tech player. I should have said this before now. The model basically likes to buy low and sell high, and sometimes that can get me in trouble, get everyone in trouble because things keep going down or things keep going up. But most of the time, the large majority of the time, the way there's an intelligent rotation in the market, and there's a rotation out of things that have moved up a lot. It happens within the sectors relative to the index, and then the groups relative to the sector, and then the stocks relative to the groups. So anyways, cybersecurity is the only tech group that model likes. You can say, obviously, with all the uncertainty in the world, maybe there's a potential catalyst for that. Can you slide back up a little bit? Let's look at the short ideas. Okay. So top of the list, Meta, Google. Like I said, semiconductors, NVIDIA, Micron, really overowned. So these are the big tech stocks. And, I've had a few bad calls on these, obviously, along the way. I freely admit that. But the forecast is still there. And again, NVIDIA, double top, hasn't really followed through. Everybody in the world owns it, thinks it's, the greatest thing since sliced bread. Internet stocks, these are kind of crummy companies. Uh, it's a broader group that I have. Social media, same kind of thing. Spotify, that's a buy, that's a sell high stock if I ever saw one. Pins, pin interest, and software stocks. Those have really worked as shorts, by the way. Is underperformed. They're still there. It's not at the top of the list anymore, but if you go back over the last few months, there was a huge rotation out of these. The model really caught that. Um, let's see, financials. So, you know, securities brokers and money center banks. Now they've reported the model forecast says these things are going to underperform. So I don't like financials at all. And then these groups below, you can see there's some cyclical groups, construction and engineering. They had a big benefit from the Biden, stimulus program. They're way up in the stratosphere. If you're looking for a sell high short, there you go. Retailers look terrible. By the way, Amazon's in that. Amazon's on that list. They Standard and Poor's stuck it in the retail group for some reason, even though they probably make most of their money from their cloud. And then industrials, you could go down the list. There's a lot of cyclical stuff. So you asked me about Russell 2000. A lot of these stocks are Russell 2000 stocks, and they're more like mid cap, not necessarily small cap, but the model does not like cyclical stuff. So I looked at it real closely after the reversal last week, and the signal's still there. So metals and mining outside of gold look bad. Steel companies, chemicals, auto components. You just anyways, enough time spent there. Let's keep going down. Can you slide down, please? Okay, Europe, same kind of thing. If you're a European investor, I really like telecom there. So it's the equivalent of Verizon's, in the US. These are very defensive, higher yielding stocks in Europe, and they're not popular. If you look at we'll go down maybe in a second and look at the chart. This is a buy low, not yet. Stay there, okay? Hang on. So telecom, the major ones, Deutsche Telekom, Swisscom, BT, things like that. Even Orange, even though France is a mess. Healthcare in the gutter, starting to take off. Not the obesity drug ones; those are way up already. Utilities, again in the gutter, not popular. Food and beverages, totally in the gutter. These are the kind of stocks that look like I want to outperform in Europe. Now, it's not like I expect a huge, 40% absolute gain in these things. These are chicken longs. So basically, it reinforces my idea. European markets are topping, rolling over. The rotation is going into defensive names in Europe, real estate in Europe too. Okay, even SBB. Some of these. If you look at the chart, we'll go there in a second. Really in the gutter. So if you're looking for alpha in Europe, the model really likes these out of favor, really depressed names that nobody likes. It's a Sir John Templeton, buy at the point of maximum pessimism. And then what are you supposed to sell? Look at the right-hand side, autos. That's been working. So autos been top of the list for like a long time, month or two. A lot of them are down already. If you look at VW or Porsche, they're down a lot. For current shorts, I like the tire companies. So Pirelli and Michelin. Looking for a European short, look at those. They're way up. They are, and Renault also. Those top three. So buy, a sell high prospect in a sell in a group that's supposed to keep underperforming in a recessionary environment where their fundamentals are probably going to be terrible for a while. Those are my top two shorts in Europe right now. Industrials look terrible in Europe. I can't understand why people keep buying these things. Like if you look at the PMIs for Europe, they've been terrible. Industrial production in Germany, it's just been terrible, terrible, terrible. And yet these stocks are still hanging up there in the stratosphere. So a lot of these European industrials, terrible. Banks, fresh signal, only a week or two old. They're way up. So Commerce Bank, Credit Agricole at the top at the moment. A few Spanish banks in there, a few Italian banks. Basic Resources, that's a fresh signal. That kind of gets back to what's happening in China. So the model does not like China. It thinks China was so you think about what happened here this year. You had to buy China. Remember that? China. It's so great. It's going up. Everybody like, barged into China, topped out, rolled over. I think it's going down. Okay, Japan, have to buy Japan. Japan. It's so great. It's over. Got to buy Japan. I think Japan is topping out and rolling over. So what does that mean for things like basic resources? That's a fresh ad. So you can see Anglo-American, Rio Tinto, things like that. Those are on my sell and short list in Europe. Construction and materials, those stocks are way in the stratosphere, rolling over. Travel and leisure, terrible. Like even with great, everybody's going to Europe. The airlines seem to be having great, passenger traffic. The stocks do not look good. They look terrible. So, and they've been acting bad, and they're supposed to keep acting bad. And then technology below that. Logitech is just rolled over in Europe. So that's if some of these stocks, there's not that many great tech stocks in Europe compared to the US. There's not a lot of tech plays, not a lot of innovative companies. There are some, but anyways, I don't have to be, I'm not a perma bear, perma bull. It's like, where are you at in the cycle? What is the model saying? At some point, these things will be a buy. Right now, they're a sell. So if you're looking for a short in Europe, Logitech looks to me like it's rolling over. And then below that, personal and household goods, keep rolling down. Luxury stocks, terrible. So what's this telling you? Like, so people think, the U.S. economy is doing so great and the rich people are making money in the stock market. Take a look at these. These were very overowned. LVMH, Hermes, Christian Dior, Burberry getting thrashed, L'Oreal. So what's that say about what's going on in the world? China, look, a lot of the sales are in China. So this is bearish for the global economy, basically, and retailers and chemicals. All right, so let's just scroll through the rest of the report real quickly down. Emerging markets, back up. So you can see China, that's what I was talking about. China had that kind of blip. I think it was a bear market rally. It's rolling over. Then some of these other ones, I don't understand what they are doing up here. Peru, sorry, like this huge rally. It hasn't gone anywhere for maybe 3 or 4 months, but these are absolute charts, not relative value. Greece, scroll down a little bit. Greece, hello, what is Greece? Like, I don't know if you can short, if you have any looking for short ideas, look at Turkey, Greece, Hungary, Poland, Colombia. These markets should not be up like this. I think like somebody's like made this huge allocation into emerging markets, just like they did into China. I think these things are topping and rolling over. Same thing, roll down next chart, next page. Okay, same thing. Here's frontier markets. Obviously, nobody's biggest holding, but it's the same idea. Just think of this as a view of what's going on in the world, okay? Bulgaria. Well, it's just gone from, it just doubled, in the last 18 months or so. What? It's right next to Ukraine. Maybe money's pouring in from the war or something. But I mean, these places are vulnerable. Keep going down. Bosnia and Serbia, those are rolling over. Argentina, that was a favorite lawn for a lot of people. I have it topping along with most Latin American things. Okay, now quickly, gold mining. Okay, here's, if I was getting this report and I was a stock guy, I would look at that page 6, which is the industry group. We already went over, the long and short ideas in the US. And then here they are in visual terms, the same thing that was on that page. So you can see gold mining relative to the S&P is still not up very much. Yeah, it had a 40% rally, but compared to where it came from, I think there's a lot of room left in gold mining stocks. REITs, that's what I showed you. REITs, already seen that picture, in the gutter, time to buy. Electric utilities had a rally, pulled back. I think it's taken off again. Multi-utility, same thing. We'll scroll down a little bit, just halfway down the page, please. Pharmaceuticals, see that? Really a buy low thing right there. They haven't outperformed. I think they're headed for alpha. Biotech, same thing next to that. Oil and gas right on the 200-week average in relative terms. Energy service, same general theme. And okay, roll down a little bit more. Bottom 2 charts, same thing, buy low. These are buy low and looking for alpha, buy low. And okay, here's where you sell high, next page. Please, Mark. Okay. Interactive media. It's gone straight up for a year and a half. That's Meta and Google mainly, the two biggest weights in that. Had a phony breakout a couple weeks ago. See that reversed. Those are my top two shorts within the S&P 500. That group right now. And then semiconductors, unfortunately, I was on the wrong side of that last spike up with NVIDIA, but it doesn't change the overall view of top. Sell and short these things on rallies. Obviously, people still want to buy them, so you don't want to sell them in the hole, short them in the hole. But when they ramp them up, you sell and short into strength. And then below that, you can see the rest of these internet, they're not up so much, but they're rolling over. Internet, social media, they had a little bit of a bounce, but they're rolling over. Software, same kind of thing. Brokers, money center banks, construction engineering. Okay, next page. Okay, here's Europe. Telecom, buy low. See, it's coming out. This is a buy low. It's like buying a value stock or something. That's telecom group, super sector relative to Euro stocks. Excuse me. Same thing with healthcare, buy low. Utilities, buy low. Food and beverages, buy low. So they're not going down anymore in relative terms. They're outperforming a little, not by much, but I think they hit the relative low a month or two ago. A lot of these, by the way, a lot of the top things at macro level, European indexes top back in May. Where are we now? June, July, 2 months ago, right? That's what it looks like to me. Roll down towards the bottom of this page. You can see autos, they're plumbing new lows. Okay, so this is a sell low, not but the two stocks that I like as shorts there don't look like that. They're so way up. The top three, Pirelli, Michelin, and Renault, they're not in the gutter. Industrials, see that group? What the heck is that super sector doing up there with the European economy in the doldrum, the Chinese economy headed down, their exports not working, their PMIs in negative, in recessionary territory, industrial production declining. What are these stocks doing up there? It's just there's so many of them. Of course, this is what Germany is all about, right? That's the strength of Germany, right? They're manufacturing. That's what's great about them. But in a down cycle, it's the wrong place to be. In a global economic downturn, these stocks are going to get creamed. So those are shorts. Banks, you can see way up there. Bottom left chart there. I think the banks are topping. So they're overowned. Everybody flocked into them. I think there's going to be, you can find a fundamental reason for that, probably in the economy going down. But banks and then basic resources to the bottom right, that's a sell low. They're breaking down to new lows. So next page, we'll just conclude on the chart stuff. You can see Japan, this has been working. So the sector rotation in Europe has been working really well for about the last 2 months. So you look at services, communication. Again, these are buy low. These are relative charts. Really out of favor stocks. Starting to outperform in a toppy market. Pharmaceuticals, same thing to the left. Land transport, that just popped into the new top. And those are, wow, that ratio has gone from 110 to 0.665. So it's basically halved. And I mean, that's a chicken long if ever there was one. That's trains, things like that. Okay, and then slide down a little bit so we see the bottom four charts. Transport equipment. Been working like a charm. That's been my number one sell in Japan for a while. You can see it's underperformed massively. Cars. So everywhere, cars, autos doing terrible globally. Rubber products, another auto-related group. Look at those have been the top two. Those are like working like a charm as shorts, as a negative alpha if on the short side, which you want. And then the two more recent ones at the bottom, wholesale. I think that's the one that Warren Buffett owns a lot of. That's rolling over. That's fresh. And mining. Okay, so that's quick walkthrough with the report. Let me just go over the view real quickly, and then we open up for questions. Okay, so my view is that, like I said at the beginning, this AI thing, although nothing's ever exactly like anything else, it reminds me of metaverse. Remember how metaverse Zuckerberg he lost $43 billion on metaverse. Metaverse was going to be the next big thing, right? Renamed Facebook Meta. And look what happened. So I mean, Meta is, that's sort of ancient history now, right? So they went on to make a lot of money from advertising, but that's not the point. The point is AI is being oversold and overinvested in the same way, similar way, let's say, to metaverse, except on a much, much bigger scale. So everybody and his brother is like selling. And can you imagine the peer pressure? Like, say you're like a Meta competitor or something, and you say, well, I'm not going to invest in AI. You get creamed. They say, are you crazy? AI is the next big thing. It would be, they'd tear you apart. So there's this peer pressure and the Ponzi scheme of, behavioral finance, behavioral, psychology, where you ring the bell and the dog drools, you train the dog trains. So you ring the bell, AI, and the dog drools. Gotta buy, gotta buy. So that's what's happening. Everybody. So I think this is turning into a huge overinvestment disaster, right? With little to show for it. So that's going to probably take a little while to show. That's obviously not going to happen today or tomorrow. But as the realization kicks in, it's obviously happening. People have read this Goldman report, which really, delineates very well the whole story. And investors are not stupid. Hedge fund investors, the macro guys that say, now wait a minute. Like the individual investors are buying this AI story like there's no tomorrow. And meanwhile, they made all this money in NVIDIA. Let's get out. Let's find something else. So that's what I think the rotation is about. Okay. Okay. It took a decade or so for the internet in 2000, March 2000 top, the NASDAQ went down by 83% over the next couple of years, right? Bottomed in October 2002. And the internet was obviously a thing, right? And it became a part of our lives. It's everything I do depends on it. But there was a huge shakeout first. So at the top of, Templeton's point of maximum optimism, a lot of these companies just ended up disappearing in the next few years. So I think nothing's ever exactly like anything else, but I think we're facing a similar kind of shakeout and reckoning. In the meantime, the U.S. economy continues to decelerate. Bloomberg Economic Surprise Index is at a 5-year low, and consumer sentiment keeps plunging. So I think you short Mag 7 and you buy all that stuff I told you. That's if you're a long short hedge fund, I think that's where the alpha is. So you basically get out of tech, big tech, and so those top 10 stocks are 30-something% of the index, right? So this is negative for the S&P and NASDAQ big time. So the stuff that powers the index is going to be going down in absolute terms, and as much as the other stuff goes up, that big stuff is going to be a big drag on the index. So I think the indexes are topping out finally. And okay, so now the prospect of Fed interest rate cuts is real. It's going to happen. Rates are going to fall. And so the way you play that is not long the NASDAQ. It's not long tech stocks. It's long treasury bonds. I said, ZROZ is a zero coupon 30-year. The yield curve could steepen, meaning short rates fall more than long rates. And SOFR futures, if you're a macro guy, that's the Eurodollar replacement, SOFR. I think those are a screaming buy out, a few, not the close ones, out, a few maturities out. I think that's going to work for the next year or so. Real estate's worst performing sector, currently top model outperform sector so it's gone from the penthouse to the outhouse. I think it goes back out of the outhouse, starts going up. And profits, I think, are going to be a big disappointment. Nobody's looking for it. If you look at the bottoms up thing, every Wall Street analyst expects nirvana, expects, oh boy, 10% growth, everything's great. And it gets if you look at the further out you look, the worse it gets. They don't see a recession coming. It's just like they're copying this stuff into Excel spreadsheets and seeing like, oh, it's going to be, it's always up, 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 up. So, when that hits, if the profits turn around, that pulls the rug out from under the market. Okay, so basically, the dynamic is profits, the company disappoints, Goldman Sachs downgrades the stocks. These long-only portfolio managers who are, sorry about that, my phone is ringing. Just ignore it. the sell side downgrades the stock. The buy side says, "Oh, it's time to sell Meta," and then they sell Meta, and then that process kind of keeps going, snowballs, stock after stock after stock, and then all of a sudden people say, the long side guys who are like in the Barron's, big money poll this week, thinking the market goes up forever, say, "Oh, we're going into a recession. Maybe its profits will decline. Maybe I should lighten up on stocks." And then finally the slow moving, whale. It's like turning around an aircraft carrier in San Francisco Bay or New York Harbor. Finally, we go into this bear market that extends for a while. So for right now, I think there's a nice long short opportunity. Gold stocks, REITs, number one. Then I showed you the other stuff. And then shorting all these big cap names that everybody owns that they're going to be puking. And that's pretty much it. Okay, questions. Now, let me go back. I had a couple questions, Mark.